So yes, welcoming you all once again on our Shashtrarth session, Cool with Co-lending, analyzing the scenario after RBI FAQs on PSL. There was a very recent amendment to certain provisions of the PSL guidelines that are applicable for banks. The amendments were, for instance, clarity on the definition of MSME, the change in definition that happened, reference to that, adjustment for weights in PSL achievements, and there were three clarifications in short. But along with this amendment to PSL, what RBI did was also issue FAQs on PSL. Now, these FAQs, though, are specifically for priority sector lending by banks. However, one of the ways in which banks can achieve their PSL targets is through co-lending. There is a specific guideline, which is co-lending guidelines for banks and NBFCs to achieve their PSL targets. So the one part of these FAQs specifically focus on co-lending. Now, given that co-lending guidelines that we have today is specifically for PSL loan, and it is the only regulatory reference for any co-lending arrangement. It can be either between banks and NBFCs or two NBFCs for PSL, for non-PSL. These amendments become crucial for us to analyze whether the clues that we get from these FAQs, would it be relevant for all co-lending transactions that are happening in the market? And what are the implications of such clarifications that the regulator has provided by these FAQs? This would be the matter of discussion for today. To begin with a basic understanding, we all understand that co-lending is a contractual arrangement between regulated entities where two or more lenders come together to advance a loan or credit facility to a particular borrower. Now, the motivation for co-lending for the co-lenders may be numerous. It could be because of the size of the loan, because of having specific restrictions on exposures, concentration norm, because of risk management, differential origination capabilities, and so on. So it is quite common for two entities to come together by aligning their differential abilities and creating a win-win situation for themselves. Today, in this Shashtratha series, we have with us Mr. Vinod Kothari, with whom we intend to discuss the gray areas around co-lending and in light of the clarifications that the RBI has provided via its FAQs. So the first question that I have in this regard is, if you could maybe explain to us CLM1 and CLM2, we commonly hear about these two terms. What is the legal acceptability of CLM1 and CLM2 outside PSL?
So that's a very important question to start the discussion, and because this question is coming quite early on, a lot of people, maybe let's assume that people might be joining subsequently as well. Therefore, this question is coming early on, but nevertheless, I would like to answer this question now, and I would like to answer it with whatever precision I can bring in my answer. So let me just first make the bold statement by saying that there is no such thing called CLM2 outside of PSL. And this is quite a strong statement to make, so I'll repeat it and then I'll go and explain why do I say so. There is no such thing called CLM2 outside of PSL. Now, what's the so-called CLM2? Basically, the loan has already been originated, and subsequently the funding co-lender comes and picks up what loan or loans does he like to pick up. In other words, it's a pick and choose approach, so-called cherry pick approach. The loan is already existing, someone comes and picks up the loan. And that's precisely what happens in case of TL as well. There is a loan which is already existing. The transferee of the loan comes in, buys the loan. Now, there is a regulatory requirement for a minimum holding period there. And that minimum holding period prescription is not without a rationale. This rationale is quite well tested. This is a product of the global financial crisis, the so-called originate to distribute model that was prevailing during the crisis. Regulators all over the world thought, and that's exactly what is scripted in the RBI regulations as well, that no lender will originate a loan with a view to sell it. In other words, if you are originating a loan with a view to sell it, then that's breaching the basic fundamental premise of lending. because that's actually originate to distribute model, therefore that's barred, and therefore a minimum holding period. You should nurture the loan. The originating team does not even know that the loan can be sold, therefore the loan is originated, nurtured, seasoned on the books of the lender, and after a minimum holding period, which could be 3 or 6 months depending on the tenure of the loan can be sold. So there is a certain discipline that is applicable for a loan to be sold after origination. Now, the so-called CLM2, which is the October 2020 guidelines of the RBI, and very explicitly the guidelines are focused on PSL. But the whole co-lending guidelines are focused on PSL only. You're right, Anita. But the RBI has spoken about PSL. RBI is not talked about co-lending outside of PSL at all. There is a reference, and I'm sure you are aware that digital lending guidelines talk about in indirect way makes a reference to CLM guidelines, but the so-called guidelines are basically for PSL. There the RBI says in case of PSL, we are giving a specific carve-out that you could do a transfer of the loan subsequent to origination without adhering to the minimum holding period, without MHP requirement. So that carve-out, that exception is an exception in case of PSL lending with a specific purpose. The purpose is quite clear, to allow the borrower the benefit of lower rates of interest, which is, I mean, given the inclusive nature of the lending, I mean, given the PSL nature of lending, that's exactly what a benign motive of the regulator could be, to allow the borrower to avail cheaper rate after the loan has been originated. Now, a fundamental question comes: if loan is already originated and subsequently we find someone to buy it, how do we pass on the benefit of cheaper rate? Because the loan is already there. But there the answer could be that on a portfolio basis, you know that, well, most of the loans will be picked up. There is a pre-existing agreement though. There's a pre-existing agreement. Although all that I have is a discretion to pick and choose. I have a cherry picking discretion. I have a no discretion as far as the arrangement is concerned. The arrangement is already there. But I can pick up or reject loans based on my discretion. That's the only so-called CLM2 model, where in context of PSL, the RBI said you don't need to adhere to MHP. But the moment you talk about a loan which is already originated outside of PSL, we talk about a loan which is originated. In order for the loan to be assigned or sold to anyone, be it, I mean, call it co-lending, nomenclature of co-lending does not matter, because even in case of TLE, there can be a partial transfer. In TLE also you can do a partial transfer of a loan. So the so-called CLM2 is nothing but a partial transfer of a loan, which therefore has to adhere to the MHP condition as well. I can see some participants are posting and typing questions right away, but which is obviously encourageable. I mean, we like to encourage people to post questions, but we would rather request that you might probably hold your question for some time, because otherwise we'll find it difficult to scroll through the questions once the question becomes long. And therefore kindly hold them for a while. Let's proceed to an extent. So what I was therefore mentioning is that the moment you talk about transferring a share of a loan which is already originated, we need an MHP. And the moment we say MHP is needed, that's a TLE. So CLM2, which is applicable in case of PSL, is still bit different from TLE. CLM2 is akin to TLE, but not TLE itself. Because in case of TLE, couldn't have had the intention of selling the loan. In CLM2, clearly have that intent. In CLM2, you already have existing agreement that there will be a loan to the co-lender. So it's not TLE itself. It's TLE with some exceptions. So TLE, in substance, it needs to adhere to the discipline of TLE, but I wouldn't call it TLE. But that CLM2 exists in the context of PSL only. Outside of PSL, I can't understand the existence of so-called CLM2. So what we have is only two things. Number one, so-called CLM1, or we have a TLE. That's the way I would like to take it, Anita.
Right. So what we understand is that CLM2 does not exist outside PSL. And in case of PSL loans, CLM2 would be akin to TLE with certain exceptions. That is, for instance, the MHP exception. Now, coming to straight away the market parlance. In market, we know that several co-lending transactions do happen wherein the risk retention, which is the part that the originating co-lender has to retain in its book, is maybe as less as 10%. So sometimes even lesser than 10%. Is there any minimum co-lending share, or is it completely contractual that the co-lenders may agree between them? Is it anything that you would suggest has to be a minimum skin in the game sort of a risk that the originating co-lender should take?
So right, once again, Anita, this takes us back to the regulatory philosophy in the so-called risk retention. Risk retention requirements are common across all over the world. Risk retention requirements in other jurisdictions may be something like 5%, something like, let's say, some cases completely exempted. In India, with absolute discretion, the RBI imposed the risk retention requirement of 10% in case of transfer of loans. TLE, there's a 10% requirement. The requirement can go down to 0 if the buyer has done a full DD on the loan, or if it's a single loan where the buyer has done his own DD. Pool of loans the buyer has done 100% DD. In that case, the requirement can come to 0. But the issue basically is the buyer has done his DD. If the buyer has not done 100% DD, in that case, there is a 10% risk retention in case of TLE as well. When we talk about co-lending, there is a substantial dependence of the funding co-lender on the originating co-lender. When I say originating co-lender, I will mean mostly the NBFC originating, and then funding co-lender mostly would be a bank. So think of originating co-lender, funding co-lender. Originating co-lender is the one who actually captures the borrower. He does a preliminary DD. We are still saying an ex ante. Ex ante basically means prior. DD has to be done by the transferee by the funding co-lender as well. So there's a DD to be done, but there's a substantial dependence that the funding co-lender has on the originating co-lender. Capturing the borrower, servicing the borrower, collecting data from the borrower, doing KYC on the borrower, etc. There's a substantial dependence on the originating co-lender. Originating co-lender therefore must have a minimum skin in the game, which in case of PSL was stipulated as 20. Now 20 seems reasonable because in case of TLE we're talking about 10%. TLE is still based on a complete takeover with no risk and rewards retained by the transferor to the transferee. In case of co-lending, it's not exactly 100% risk reward transfer because the co-lenders remain partners in business, and therefore in order for the originating co-lender to call himself a partner in business, a co-lender, and not a mere transferor, the co-lender needs to have a certain skin in the game, which was stipulated at 20% in case of PSL. In my view, as we move out of PSL, we cannot disown the basic tenets, the basic principles, the basic structure of co-lending, which is prescribed in case of co-lending. We can apply co-lending outside PSL, but with the same structure which is proposed by the RBI in case of PSL. I find no reason. If 20 is prescribed in case of PSL, I have no reason to say that the share of the originating co-lender can be less than 20. I am not able to justify that. Because if there is no reason to contend that non-PSL lending is safer, or there's no reason to contend that the role of the originating co-lender is any less in case of a non-PSL lending. So there's no reason to deviate from 2080 principle which is laid in case of PSL. So to my view, in any event, PSL or non-PSL, if it's to be called co-lending, the risk retention by the originating co-lender should be 20. If it's less than 20, I would not suggest that, because either it's too less skin in the game or too high leverage. When I say too high leverage, please also appreciate that we talk about, for example, let's say talk about 20 to 80. With the 20% investment, the originating co-lender is able to build an asset worth 100. So it's got a 5 times leverage there. It's got residual returns on 100 while participating only 20. It's got a 5x leverage there. His own balance sheet might also have 5x leverage because he's got a leverage on the balance sheet as well. That 20 is coming from the aggregate balance sheet, which is already leveraged. If there's a 5% leverage on the balance sheet, there's a 5% leverage in the co-lending transaction. We're talking about 5 into 5, 25 times leverage. If we bring down the retention to 10%, we're talking about a 50 times leverage, which to my mind becomes very risky. It is these high levels of leverage which were responsible for something like the global financial crisis. So other than a regulatory answer, I would still also say prudentially also, I would not suggest bringing down the originator's share in the loan book to anything less than 20. Anita.
So what we can conclude is that for both PSL as well as non-PSL, the minimum risk retention, going by what RBI has suggested for PSL loans, we should suggest as 20% in both the cases. Now, this is the minimum requirement. Let us talk about the maximum. Now, as per the RBI FAQs, the first FAQ itself clarifies that in case of priority sector assets on the bank's book, it should at all times be with without any recourse on the NBFC. This is a clarification that RBI has provided to the question, wherein the question was, can the co-lending arrangement allow the NBFC to retain 100% of the risk? So this means that the recourse that the bank can have on the NBFC should also be, in some case, it should also be limited, or can there be no recourse on the NBFC? What is the view that is coming out from this particular clarification that RBI has stated?
So actually, this clarification is very, very important. To my mind, this is saying multiple things, and it's extremely important FAQ. So I think one of the major inspirations for us to do this Shastras today is this question number, I guess, 45 in the PSL FAQ. This question number 45. It's a very, very important question. Answer is not as pointed as one would have expected it to be. Usually, when find RBI is not like so very, I mean, sharp and pointed in the answers. The question was very, very sharp and pointed. And the RBI's answer was a little blunted, but nevertheless, it says a lot. Now, it says actually two things. First, common practice in the market seems to be that one of the co-lenders provides a complete guarantee to the other co-lender. A co-lender providing a guarantee, the originating co-lender giving a guarantee to the funding co-lender, saying, I am the LSP as well, I am giving a guarantee. That becomes completely ruled out because this question says, the answer says that the NBFC or the originating co-lender cannot provide recourse to the bank. The bank cannot have a recourse to the NBFC. That would mean the bank cannot look at the NBFC to meet whatever shortfalls there are in the collections so as to have a direct recourse. That's part one, that co-lender cannot be a guarantor to the other co-lender. At the same time, the other implication which is coming from the question is that while recourse is prohibited, but other forms of credit support, if at all you're able to structure a credit support which is not amounting to a recourse, which is not amounting to guarantee, recourse and guarantee seem ruled out completely. But the RBI is not at all talked about a pari passu sharing of risk and rewards. It's talking about sharing of risk and rewards. But then goes to say the sharing of risk reward can be as per the management objectives. It uses words to say that it's actually reiterating the first line of the October 2020 circular as well, which is talking about sharing of risk and rewards. And it doesn't use the word, consciously doesn't use the word pari passu or proportional sharing of risk and rewards. On the contrary, the sharing of risk and rewards can be as per their aligned with their objectives. So what is actually therefore goes to say is that while there will be sharing of risk and rewards, in other words, the funding co-lender cannot lean completely on the originating co-lender and expect a certain pre-agreed rate of return coming from the originating co-lender. At the same time, the regulations are not expecting the sharing of risk and rewards to be completely proportional. In other words, now I'll give another example to further fortify the point I'm trying to make. In a securitization transaction, an originator cannot provide recourse. Recourse is ruled out there as well. But can the originator provide other forms of credit support? Of course, yes. Securitization transactions are essentially premised on originator support. Originator support becomes the most important, I would say the most important pillar, most important building block of a securitization transaction. Recourse is ruled out. Credit support, however, is not ruled out. Here again, the RBI is very consciously talking about recourse is ruled out. It's nowhere saying that credit support by the originating co-lender to the funding co-lender is ruled out. So use of structured waterfall device, use of prioritization or subordination, or use of a structured waterfall, not amounting to full recourse on the originating co-lender, in my view, seems there's something that we have opined earlier as well. We've very clearly held this view. And I think with these FAQs in context of PSL, our view that structured co-lending arrangements are still permissible seems to have gathered further strength. Anita.
So if I have to say that originating co-lender can has an option to provide several things. It could be a guarantee, recourse, or any other form of credit enhancement to the funding co-lender. Are we saying that none of these can be provided?
Guarantee, no. Recourse, no. Subordination, I would say yes.
And can the originating co-lender assure any rate of return to the funding?
Once again, no. I would say no, no question. Now, therefore, to be more specific, There could be a waterfall arrangement. For example, say of all the cash flows, interest will be paid to the funding co-lender first. That's what you call first to go prioritization. Senior junior structure. Senior junior structures exist elsewhere in the world as well. In our FAQs also we've stated that this is something which is an international practice. In the so-called co-lending which exists elsewhere in the world, there's a first to go co-lender, there's a last to go co-lender. So here as well there's a senior co-lender which is so-called first to go. There's a last to go or junior co-lender. Therefore, first the interest at a particular rate. The moment you say first somebody is paid, then we're talking about interest at a particular rate. So like I commonly suggest that you could probably define several levels. Up to a particular level, interest will go first to the funding co-lender, then maybe the principal to the funding co-lender, then maybe interest beyond that particular level up to another level. Level 2, for example, will go to the originating co-lender. And then if we have at all an excess which is over level 2, level 1 will go to the funding co-lender, level 2 will go to the originating co-lender, level 3 will be split between the two. Therefore, both have some degree of sharing of risk and returns. Neither has guaranteed a rate of return. For example, if at all the actual returns from the portfolio drop below level 1, then the funding co-lender will also have a shortfall. So it's possible to have a shortfall. Had it been a guarantee, that would mean if there is shortfall in the so-called assured or target rate of threshold rate of return, then the originating co-lender will make good the threshold. I'll pay from my pocket. That's what is guarantee. No, I'm not saying that. I'm saying I will not pay anything from my pocket. All I'm saying is that until you get your threshold rate, I will stay quiet. I'll not stake a claim on the cash flows until you got a threshold. Once you got threshold rate, then I'll collect the rest of level 2 cash flows. Level 3, well, both of us participate. So both of us have a risk. Both of us have rewards. This kind of a structured arrangement, in my view, is possible. This is
So,
what we said possible earlier as well. And we are reiterating that because I think we get a little strength. I don't say little, we get more than little strength from the FAQs because once again, the RBI is very clearly not talking about pari passu or proportional sharing of risk, but is clearly prohibiting a recourse or a guarantee, which also in the past we were very clearly saying there's no question of a co-lender assuring a rate of return. There's no question of a co-lender giving a recourse. There's no question of a co-lender giving a guarantee. Be it digital co-lending, you'd probably ask me this question, Anita, but I'm sure you're going to ask that can the originating co-lender contend that I am the LSP and therefore I can give a guarantee? And even before you ask this question, you could probably ask it. I'll maybe then say in detail.
Yeah, because it is connected with guarantee, because you said that guarantee cannot be provided, and we are very well aware of the terminology default loss guarantee, specifically in case of digital lending. So wherein is a RBI allowance to provide or to take 5% DLG from my LSP. In a co-lending kind of an arrangement, can this be said that one of the co-lenders, that is the originating co-lender, is actually the sourcing and servicing agent, is actually my LSP, and can therefore the originating co-lender provide this DLG of 5%?
So for the DLG to be provided, there are two conditions. Number one, the lending has to be digital, which is quite easy these days. I think I can probably prove that any lending that happens in the world of lending can be, to an extent, is always digital. So I can probably contend, though that's not my view, but I can contrive to say that every lending is digital lending. So it's easy to prove that lending is digital. Second point, second requirement of giving DLG is DLG can be given only by an LSP. Someone other than the LSP cannot give DLG because that would amount to someone who doesn't have a stake in the process, somebody doesn't have a role in the process to give a guarantee. Now, the question for us would be, in a co-lending transaction, can I contend that co-lender 1, the originating co-lender, is the agent for co-lender 2? We are saying two things. Number A, we are saying it's a mutual arrangement where both of them are lending together. We are lenders together. We are partners in business. We are co-lenders. Am I saying that I am originating for or on behalf of co-lender 2? I'm saying two of us are co-lenders. Both of us are taking the loan on our books. Discretionary, non-discretionary, but the loan is co-lent by both of us. I cannot be saying that I am acting as agent for the other. The co-lending arrangement will allocate mutual responsibilities. For example, one might have a greater role in origination, one might have a greater role in servicing, other one might have a greater role, for example, in funding. The roles could be different. That's true for every partnership. partners have different roles and responsibilities, but I cannot say one partner is agent for the other. Similarly, here in co-lending, given the very construct of co-lending, I don't think it would be possible to say that the originating co-lender is acting in the role of an agent for the other co-lender. Therefore, neither is the agent. And that would also bring up several questions. Can they be servicing? I'm sure the questions are anyway coming up because some participants also asked this question. And maybe the answers would therefore be connected with this. In our view, both co-lenders are co-lenders. Both are lenders. Neither of them is an agent for the other. They have a mutual joint arrangement to lend together. There's no agency principles. Both are acting as principals in relation to the borrower. Borrower has borrowed from both. I cannot be saying that the co-lender 2 came through the co-lender 1. No, that's correct. That's not correct. The borrower has borrowed from both of them. So both are principals in connection with the borrower. Neither of them is agent acting on behalf of another principal. So it's not an agency principal. See, both are acting as principals. It's principal to principal contract, lending to the borrower, not agent principal and thereby connecting to the borrower. I hope my point is coming. Agent principal would have mean there is an agent who is fronting. There's a principal who is coming via the agent, and then via the agent, the principal is reaching out to the borrower. No, that is principal agency. Here, the two of them are lending together, and both of them are lending to. They are joint lenders to the borrower. The borrower is the promisor. They are the joint promisees in contract law parlance. It's a joint promise, not agent principal contract.
Right. So that becomes a view that in case of co-lending, DLG is not permissible because the co-lenders are...
DLG is permissible from a third party, from an LSP, not from the co-lender. There could be an LSP. There could be an LSP who is acting as agent for both of them, who could be providing DLG perfectly okay. But the co-lender cannot say that I am the LSP and therefore I am providing DLG.
In that case, will the co-lenders get the DLG on an aggregate basis of 5% from the third person, or will it be 5% for both?
No. Joint lending arrangement. The co-lending arrangement has the benefit of 5%. It's not 5 into 2. It's 5% for the joint lending arrangement. Therefore, for example, I mean, just to like open up avenues for discussion. For example, if there's a technology platform that my company has, and that technology platform could become LSP for both of us, and that LSP provides 5% guarantee to the joint lending arrangement. The benefit of that goes to the waterfall. So I talked about a waterfall. The waterfall will first be supplemented by the cash inflows from the guarantor. The guarantor is a third party whose cash inflows will fill the waterfall first. From there, the money goes in the particular order to the two co-lenders.
Understood. So now let us take one by one both these models. CLM1, talking about CLM1 first. In case of CLM1 or non-discretionary co-lending that we commonly call it as, the due diligence by the banks, is it to be done before the disbursement or after the disbursement? Because there is this concept of ex ante due diligence. What is ex ante, ex post due diligence, and what can you explain these terms and let us know the significance?
The RBI use the word ex ante.
Yes.
The opposite of which is ex post. So I think it's very clear. In case of CLM1, it's non-discretionary. Therefore, I'm supposed to have done my DD before the loan was disbursed. To what extent have I done it actually? To what extent have I done it algorithmically? To what extent have I done it relying on a model? That's up to me. I could probably say I'm lending based on algo. I'm lending based on a formula. I'm lending based on, it might be parametric lending, for example. I may not have sort of done a granular study of the loan. I might have done it parametrically. That's my approach. That was my approach, which was appropriate for the loan in question. I have done that ex ante DD. Therefore, the loan was disbursed after I have done my DD. In essence, I cannot subsequently go and say that, oh, I don't like the loan. There's no question of not liking the loan because the loan was done after due diligence done by both the co-lenders, including the funding co-lender. Ex post DD, that would mean pick and choose. Loan is disbursed, thereafter I come and see. Now, the so-called CLM2 is not therefore happening after a month or couple of months or 3 months. That is what happens in TLE. In so-called CLM2 in context of PSL loans, the application of discretion is the question of the co-lender picking up loans that he likes. should also happen on back to back. RBI use the word back to back. Back to back once again means one after the other. Loan is originating, then the CLM, the co-lender comes and says, okay, you originated 100 loans, I'll probably take 75 of them. We already have a pre-existing arrangement. There's an irreversible agreement already, but the agreement also allows me to pick and choose the loans that I like. So I pick up 75 out of the 100, and therefore I take those. That happens soon after origination. But I'm saying there could be therefore a reasonable batch processing gap there, but it happens soon thereafter, and therefore the based on ex post DD, meaning subsequent DD, the funding co-lender picks up the loans that he likes. So ex ante means prior, ex post means subsequent, and therefore one of the FAQs to which the RBI is given an answer. In the so-called CLM1, it's not permissible for the funding co-lender to come and say that the loan did not comply with my conditions, and therefore I throw it back on the originator, because the loan was disbursed after DD of the funding co-lender. So it's not open for the funding co-lender to reject a loan saying it's not fitting into my criteria, because if it wasn't fitting, it shouldn't have been disbursed at all. Anita?
Right. So in this case, when you're saying that in case of CLM1, there has to be an ex ante DD, and I cannot be rejecting the loans once it has come into the books. Now, the same situation this may not be the same in case of CLM2. Now, over there, RBI, you just mentioned that RBI has clarified about back-to-back basis, which implies that the loans will first be opened in the books of the NBFC or the originating co-lender, and then the bank will open the loan account subsequently. While discretionary co-lending does allow me to onboard after the loan has already been disbursed, the question is how much time may elapse between the origination of the loan and the acquisition of the share by the funding co-lender? Can the financing co-lender, for example, come after 3 months of origination, and can it still be called as co-lending?
So Anita, because some participants came subsequently, therefore I'll first like to repeat the point that we made immediately as we began, that CLM2 as a concept exists only in context of PSL. Outside of PSL, the concept has no existence at all. So we're talking about PSL when you talk about CLM2, we're talking about PSL co-lending, PSL lending. Now, CLM2, which is supposedly akin to TLE, is exactly not TLE. And this is something that I'm also reiterating because we've mentioned this earlier as well. TLE requires an MHP. CLM2 doesn't require MHP. TLE cannot have the originate to sell intent. CLM2 obviously has that intent. In CLM2, the sale happens soon after origination. In TLE, the sale can happen anytime after origination. It can happen after 3 months. It can happen after 30 months also. So the loan was nurtured and the loan was originated in the books of the originator without an intent of selling. In case of TLE, I can later on decide. It's a question of, therefore, subsequent decision to sell something which was already originated with the intent of holding it on books, as opposed to CLM2, where the intent was always to sell, just that the transferee, the funding co-lender, had the discretion. So CLM1 and CLM2, the only difference is existence of discretion, the ex post TD as we referred to, but the processing should happen soon. When I say soon, I cannot lay a numerical number of days, 7 days, 15 days, 10 days, maybe a month. The idea basically is that you are supposed to be on board right from inception. It is not a case of subsequent transfer similar to a TLE. Therefore, you're supposed to be on picture as soon as the loan has been originated. You would probably take some time for the so-called ex post TD. You take some time for processing and approval of the loans. Do that. Do it on a reasonable batch processing interval. Do that, decide what you would like to reject, and take the rest. And that's how the so-called CLM2, in my view, it should happen soon. I'm saying how soon can be soon is left to people's own decision.
Right. Okay. Next, let's come to the funding part also, because when we are discussing about originating the loans in the books of both these co-lenders, first in the books of originating co-lender and then back-to-back basis in the books of the funding co-lender, it has often been opined that the share of the funding co-lender should be with the originator in the beginning itself. So the money must lie in an opinion. Is there any clarity that the RBI FAQs has brought in this regard?
Yes, the RBI has given clarity on that. Question 51 of the PSL FAQs is exactly on this. And I will just repeat the question for the benefit of everyone. Query 51. Based on the loan documents executed, will the NBFC sanction and disburse the whole amount and thereafter approach the bank for reimbursement? Or will it sanction stock disburse its part of the loan and then approach the bank to sanction or disburse its part? That would mean, should the originating co-lender only be disbursing its share, for example, 20% only, and expect the bank to lend 80%? So that's how the money flows from the bank to the borrower directly. This was a question. Clarification by the bank and the NBFC. The RBI saying the bank and the NBFC can decide on this aspect as per the master agreement between them. Therefore, the RBI said, we are not wanting to be prescriptive here. You can decide on the flow of funds. Flow of funds basically means what? Whether the money should be there with the originator from the inception, whether the money should be lying in an escrow from the very first day, how much money should be lying, should it come on the very day on which the loan is disbursed, or can it come the next day? Can it, for example, come after 3 days? The loan, if it's PSL1, which is what is supposed to be anyway, we are talking about PSL1, CLM1 only. If it's CLM1, from the very inception, the two co-lenders are on board. Therefore, the loan is lent by the two of them to the borrower. Both are co-lenders from the beginning. Now, if money is, for example, first put by the NBFC, that would mean the NBFC now has the right to recover 80% share from the funding co-lender. Therefore, on day one, I'll debit the loan, right? And I will also debit the right to receive. I'll debit 20% of the loan because my share is only 20. Then I'll debit remaining 80 to be receivable from the other co-lender, funding co-lender. And the cash flow therefore is 100, whereas my own share is 20. 80 is the receivable from the funding co-lender. I'll therefore be creating a loan to the extent of 20 on my books, with 80 being receivable from the funding co-lender. As and when I get the money from the funding co-lender, my obligation to share the interest with the funding co-lender will begin. In other words, the RBI is not saying the money should be there upfront, but well, people can decide. And the idea basically is that as soon as maybe ASAP might actually be interpreted as soon as maybe practicable, try and settle this 80% transfer so that you are not seeming as if you are buying a pre-existing loan. You have originated the loan from the inception. The entire transaction should not be made to look like a transfer of a loan already existing. It should, as far as possible, take the color of a loan which from the very inception is jointly originated, jointly disbursed.
Also, because ex ante due diligence was already being carried out by the funding co-lender as well. So we can say that both the loans, in case the co-lenders decide as such, they may have the disbursement being done by each of them respectively for their share.
That's idealistic. Ideally, it should be on live disbursement of both of them. But if it's ex ante DD, not ex ante fund transfer. Funding transfer between the two of them is a matter of mutual agreement. It may be prior, it may be live, momentary, or it may be with a batch processing window. But the idea basically is that from the very first day, the loan is jointly lent. Therefore, on that day, if the NBFC is the one which is disbursing the entire 100 rupees, it has a right to collect 80 rupees from the funding co-lender.
So now just a follow-up question on this itself. In both these cases, CLM1 and CLM2, in what ways loans be accounted for in the books of the originating co-lender and the funding co-lender?
Well, I think CLM2 is once again equivalent of TLE. Therefore, in case of CLM1, it's 80-20 from the very inception is 20% on my books and 80% on the books of the funding co-lender. There is no transfer, therefore there's no question of sale, and hence the entire construct of gain on sale or derecognition as is applicable in case of does not apply. From the very first day, the loan is jointly lent by both. So both should be putting their respective share of the loan in their books. To be therefore clear on the processing time. Now, while audit trail is mandatorily applicable to all the auditees currently, therefore actually the disbursement went from the funding co-lender, let's say 2 days after the loan was actually lent. I just mentioned about, let's say on the 5th of July, the NBFC lends out 100 rupees, its share is only 20, and it therefore debits a receivable of 80 rupees from the funding co-lender, and the funding co-lender therefore comes after 3 days to reimburse that money. The funding co-lender will be putting on its books the loan. If it's not being processed immediately, it would probably be processing it on, let's say, 3 days later. And there is no question of a backdated entry in the loan book, but that would breach the audit trail. So that's surely not recommendable. And therefore, if the accounting comes 3 days later, we are not breaching principle. They're supposed to be from the very first day. The loan is supposed to be originated on the day of the origination by both the parties. But if the actual entry is being made in the books of the funding co-lender on the date of remittance of the money, which may be, let's say, coming after the minimum batch processing time, I'm not suggesting any backdating, that would be breaching audit trail. But from whatever date you originate, it's from whatever date you actually, post it in your loan book, it's from that date, but it's supposed to be a share in the loan as originated from the very first day.
So in this regard, what kind of technology integration should be required between the co-lenders? Because both of them for accounting purposes, for reporting and disclosure purposes as well.
Why don't you pick up this question? So you would probably know there are apps which are probably bridging the technologies of both the lenders. There are probably interfaces which create that, but you would know better. So why don't you?
So I wanted to understand to what extent is this required? Because yes, there are apps, there are technological support that is there, but where do you see that there becomes an important integration requirement between both these co-lenders?
So the question is it so very important that there's a live processing of the loan by the funding co-lender? To my view, because last question in the FAQs of PSL, the RBI is not very prescriptive. The RBI would probably be a little liberal. Even if you take a processing time and subsequently disbursement goes, we are okay. I don't think the RBI will probably have an. So therefore, an integration to the extent that momentarily as the loan is disbursed, it's debited in the books of funding co-lender as well. That sort of live recording is, I don't think that's important. If you can achieve it, well, wonderful. I think it's too, too steep a challenge. Therefore, if you want to go a little liberal on that, that's still possible.
At this stage, maybe I can take up some questions that we had received from our participants along with the registration. So one of the questions that was asked is that provided new age NBFCs are getting into the bandwagon of co-lending, would it become an alternative for direct assignments since inorganic exposure can be taken through this route as well?
Now, in my view, it's not an alternative to TLE, but TLE basically means I originate, nurture, demonstrate the performance of loans, and subsequently sell the loan. Co-lending, like we mentioned, it's basically CLM1 only. CLM1 would mean the funding co-lender is on board from the very inception. Therefore, you have a pre-existing agreement. It's not possible. Sorry, it's not possible for the originating co-lender to provide a guarantee or assured rate of return. Both the parties can talk about the threshold rates and distribution of different levels of rates of interest, which is what I've explained earlier. But it's not. TLE, there's an existing pool of loans. TLE, of course, there is no question of any credit support by the transferor. In co-lending, a credit support, like we mentioned, in case of subordination, for example, seems clearly possible. So it is surely a way to achieve inorganic growth in portfolios. It's surely a way to extend beyond the capabilities of the funding co-lender, and that's exactly why co-lending has become popular. It's surely economically very, very viable. It's a win-win proposition for both. It's also in a way win-win proposition for the borrower and the lender, because the borrower also presumably gets better rates. He gets more inclusion, better rates. Perhaps it's win-win for everyone. There's no policy objection to co-lending itself. The policy objection could be that people are not adhering to the fundamental principles of co-lending. Anita.
Another question, and I think this has been a repeat question from several other participants as well, is on the applicability of CLM2 for PSL loans between two NBFCs. So first question would be whether we can say that CLM2 for PSL loans between two NBFCs. Is that possible? Can I call it as CLM2? And so you can maybe first
I
answer
think
that.
the very meaning of PSL, what is the relevance of PSL? Banks need priority sector lending. So a bank is in need of priority sector book. The bank approaches an NBFC which originates a PSL loan and shifts a part of the loan to the bank, and the bank then qualifies that part, its own part, as PSL. NBFCs don't need PSL at all. So where is the question of a PSL lending by two NBFCs? So I don't think CLM.
No, let me give you the idea behind this. The reason why they wanted, they are intending to classify this as CLM2 is to avail the exemption of MHP. Because if I'm classifying it as CLM2, I may get that exemption from MHP. So,
I'm not putting the cart before the horse, therefore. All I'm saying is that the MHP exemption was available in case of PSL co-lending between banks and NBFCs. That's the whole carve out. It doesn't exist beyond that. Because if the loan is already created, someone comes and picks up the loan thereafter, the whole discipline of TLE will become completely meaningless. If TLE could be avoided, MHP could be avoided by calling it CLM2. So CLM2 is not a regulatory arbitrage window. So I wouldn't say that it's possible to avoid MHP by merely calling it. In other words, the outside of PSL, which is between banks and NBFCs, the whole question of a CLM2 does not exist.
and what are your views on the term akin to assignment? Do you
Akin,
believe
it's
that
not the
loans
same.
can be transferred in any other way other than assignment?
Oh, of course, loans can be transferred in three ways. Assignment, novation. Novation, of course, is a different issue, but loans can be transferred by way of loan participation as well. So when we say akin to TLE, we're saying it's not TLE. It will have to adhere to the discipline of TLE, but it's not exactly TLE. Like I think I've talked about several differences during this Shashtrarth itself. In our FAQs also we given a complete table distinguishing between CLM2 and CLM2 is not TLE. CLM2 abides by discipline of TLE, but it's not TLE itself. There are several differences we pointed out.
Right.
Anita.
And another question that was there in the registration list as well as over here is with respect to how GST and service fee should be levied in case of co-lending arrangements.
So that brings us back to the question, is the originating co-lender acting as a servicing agent for the funding co-lender? To which my answer is clearly no. No. Originating co-lender is not a servicing agent for the funding co-lender. Both of them are lenders. Both of them are distributing the loan cash flows as principal and interest. Both of them are getting interest. Neither party is paying a servicing fee to that. There's no reason for the servicing fee to exist. In fact, one can even draw a strength from that IT80 ruling of Bombay IT80 in the case of State Bank of India, which was reported on our website some days back, which also says that the parties are sharing interests mutually. That's not one party is paying to the other. They're both sharing the loan cash flows. Servicing fee would mean somebody is paying to the other. No, I'm not saying the funding co-lender is paying to the originating co-lender. They're both sharing the same loan cash flows. So there's no question of a servicing fee. There's no question of a servicing agent role. Hence, there is no question of a GST. Both of them are charging, both of them are sharing interest in principal. For example, if there's a loan processing fee, which is taken from the borrower and it's taken entirely by the originating co-lender, the originating co-lender charges GST on that. So whatever cash flows are from the borrower and they are chargeable to GST, the GST will be charged. As between the two co-lenders, any sharing of proceeds of the loan, there's no question of GST because they're simply splitting the cash flows from the loan. Neither party is paying to the other.
I think another proposal in this direction itself, one of the participants have mentioned that can the originating co-lender not have a principal to principal contract, which is the CLM contract, say contract A, tripartite with the borrower. And then there can be a separate contract B, which is bi-party between the originating co-lender in the personality of LSP, hence the agent, and the funding co-lender.
I think this is something that we discussed at length earlier, that both of them are co-lenders, they're partners in business. They're partnering together to deal with the borrower. We are not saying co-lender 1 is originating the loan via co-lender 2 or co-lender 2 is originating the loan via, both of them originating together. So the the principal agent relationship does not exist between the two co-lenders. Both of them are principals in relation to the borrower. I think this is something that I'm only repeating what I mentioned. So this
Right.
question, I guess, was answered already.
Okay, two more questions that I'll be taking for today. Second last question is, in CLM2, the arrangement is already existing between the lenders and the asset is originated at inception with the understanding not to transfer but to ease the co-origination. In CLM2, will the asset would be considered as derecognized as per Ind AS 109 from upfront income perspective despite having arrangement of co-lending?
That's a little complicated question, and I must think whoever is asking this question must be surely an accounting expert. So the question is that if we say CLM2 is equivalent of TLE, and a TLE basically means what? There's an asset on my books which is subsequently sold. And the moment you talk about a sale of an asset, then there is a question of a gain on sale. So in case of, and I think the querist has very clearly put that this is not a case of subsequently selling something which was supposed to be owned by me. It was originating together, though I provided benefit of discretion that you could probably reject. That benefit of discretion that you could probably say no. It was not discretion to say yes, because that was already concluded. Yes, because it's talking about irreversible commitment from the very inception. That commitment, that there is no optionality there. The commitment is completely irreversible and existed on the very first day. So it's not an option to say yes, it's an option to say no. I could have rejected certain loans saying these I don't like these loans, and therefore I would not take them. That's the limited optionality. And therefore it's not a case of sale of something that you were intending to hold yourself. The loans were originated with the very clear motive of sharing the proceeds with, or sharing a part of the loan with the co-lender. So I would be, in fact, I think among the distinctions we have mentioned this also, that the gain on sale recognition does not seem appropriate in case of CLM2, because in CLM2 you're simply sharing the proceeds of the loan. So we would not say this is akin for the purpose of derecognition from Ind AS 109 perspective. Upfront recognition of gain on sale, which is the feature in case of TLE, in our view, does not apply in case of CLM2.
And the last question that we have for today is, in one hand, RBI is worried about the interdependence of NBFCs and banks. And on the other hand, it is promoting the co-lending, which will create interdependence again. What are your views on this?
जमाने में इंटरडिपेंडेंस के अलावा है ही क्या? हम जितने जैसे जैसे आगे बढ़ रहे हैं वैसे वैसे इंटरडिपेंडेंट हुए जा रहे हैं. We are not talking about independence, we're talking about interdependence. It's independence along with interdependence. सहअस्तित्व का जमाना है, ये सहअस्तित्व है, इसमें गलत कुछ नहीं है. There's nothing wrong in RBI is worried about interconnectivity. RBI is not worried about interdependence, is the rule of the game. So though the question is of course extremely philosophical, but well, this is something which is, it's actually doing what? We are trying to take benefit of a mutual, and Anta, you mentioned that, differential abilities. If people have differential abilities, somebody is strong in gold lending, and I would like to originate a gold loan book, why would I do it organic way? I would rather latch on to the capabilities of someone who is good at it. Instead of everyone trying to grow wheat, if somebody can better grow rice and the other one can trade on, I mean, the very sense of barter with which all trades would have begun. So why can't mutually beneficial trades be done between parties instead of everyone trying to stitch his own shoe or stitch his own clothes? So let people do what they're best at. So there's nothing wrong in entities collaborating for business. That's actually the right thing to do. The only thing is that we are not creating dependencies. We are not creating interconnectivity is fine. We're not creating interdependency, so that cash flow promises from one will affect the other. If the originating co-lenders promise to pay a particular amount, would be a promise made to the other co-lender. For example, obligation was cast on originating co-lender to make payment to the funding co-lender. There will have an issue, because that is where contagion impact builds in. But a shared arrangement, which actually a dispersal of risk, I think I'm all in favor of it. It's dispersion of risk. We're dispersing this, dispersing capital, dispersing risk, and therefore it contributes to financial stability rather than financial instability.
I think due to the time restrictions, we'll not be able to take further questions, but that doesn't
Anita,
mean that
maybe take,
we'll be
you
answering
can
them. No, I was
you
just
can be a
simply
little liberal,
that,
I'm sure. If you want to be a bit
I thought
liberal,
that maybe because we already have the FAQs on our website, so the questions may be posted over there, and we'll be happy to address the queries on
it's
the
up to you.
website.
It's up to you. But if there are questions on YouTube also, I'm not sure our colleagues can see if there are some questions there, or if you're a little liberal and allow another 2-3 questions here, Anita, people will
Sure.
appreciate.
Okay. Then I'll ask these questions that came after. Okay. Oh, I think these are repeat questions because can CLM2 take place between two NBFCs? Additionally, the borrower
We
agreement should be
we
tripartite.
we said no. But if there are other questions which have not been answered, and if you are
Can
grand enough,
PSL gold loan be possible under CLM2?
sorry, what hold on?
PSL gold loan, priority sector lending gold loan. I'm not sure if gold loan will come under priority
that
sector.
the typical agri thing, Anita. You're aware of that. That I can say that I've got a coconut tree in my house, and I'm taking the loan for planting a coconut tree. So I'm a farmer, and I'm pledging the gold. So I think that's the typical PSL gold loans. Gold loans are
Okay.
tagged as PSL by saying I got a papaya tree or a farm or a coconut tree, or I've got whatever other I grow some wheat in my gamla, which I pluck every morning. So I'm sorry, I'm ridiculing that, but yeah, there are a lot of people who the farmers also pledge gold. So if it's actually a PSL loan, if it's a PSL loan without getting into what kind of, I mean, agree tagging might be done without getting into any sense of lightness on that. But if it's a PSL loan, then CLM1, CLM2 both are possible. If it's not PSL, then there's no question of any CLM2.
Is there any cap on the ROI charge to end customer under PSL or non-PSL, irrespective of CLM1 and CLM2?
Not
There is
really.
a restriction under the PSL regulations on TLE. So
But
that
yes,
restriction should also extend on CLM2 because
if it's
CLM2 is
CLM2, I would say I would agree with you. I would agree with it. CLM2 is equivalent of TLE, and therefore the bar on the margin, which is applicable to TLE for getting PSL tag, should be applicable here as well. I would agree.
Can the originating co-lender not have a principal? I think this question we have already taken. This has been a repeat. Disbursement documentation in CLM1, please clarify. I'm not sure about this question. Disbursement documentation in case of CLM1, please clarify. So yes, these were the questions from my end. In case we have not been able to answer any of these questions, please feel free to post your questions on our website. We have, I think, 10 to 15 pager document. There are around
37 pager document.
So there are around 80 questions that we have. And in case you have questions, we'll be most happy to answer them and also incorporate it in our FAQs. So
Absolutely.
thank you all. Thank you, sir, for spending your time with us.
Thanks,
And
Anita, and thanks everyone.
thank you.